The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Scorebox. I'm Steve Sedgwick with Karen Cho and Juliana Tattlebaum in the studio, and these are your headlines. It's Spring Statement Day here in the United Kingdom, with spending cuts expected to top the agenda as the UK Chancellor of the Exchequer, Rachel Reeves, grapples with lacklustre economic growth. Amid reports the country's budget watchdog will downgrade its outlook. UK also gearing up for a final key data point before Reeves heads to Parliament later today, with economists in forecasting just a tad easing of the inflation rate.
Elsewhere, Team Trump doubles down as the fallout from the group chat security leak widens, with the US president defending the administration's planning of military strikes on Yemen.
You have to learn from every experience. I think it was very unfair the way they attacked Michael. He's a good person. I don't think he should apologize. I think he's doing his best.
And Ukrainian drones have reportedly been shot down over the Black Sea just hours after a ceasefire deal, as Moscow puts conditions on the tentative truce.
Lovely to see you, everyone, this morning. I think it's fair to say it's going to be a bad day at the office for the UK Chancellor of the Exchequer, Rachel Reeves, today. She will give her first spring statement. Under mounting pressure amid fears, she's pretty much boxed herself in on her spending rules, or has she boxed herself in by policy? There's the question. She is expected to announce the Office for Budgetary Responsibility, which is independent. That's the problem for the government, and problem for the last government as well, has roughly halved its growth forecast for the year to around 1%, and that's going to put a lot of pressure on the aforementioned fiscal rules. Now, this on the back of months of lacklustre performance from the UK economy. Expected to have turned her near £10 billion worth of fiscal headroom, the so-called wiggle room, to an almost £5 billion black hole. So it turned round by £15 billion. Now, just this week, the new data from the Office for National Statistics showed the public sector borrowing surged to more than £132 billion for the first 11 months of the fiscal year. That is more than the OBR had projected for the year as a whole. Expect cuts, but will they come today, or is it just the announced cuts that we're going to get underlined today? Because she has ruled out tax hikes. Again, can she say that given the situation? Well, further borrowing, she's also ruled out, certainly not for investment, but further borrowing to balance the book, so to speak. And she's also ruled out changes to her self-imposed fiscal rule that dictates that day-to-day spending rather than investment must be funded by tax receipts in the current Parliament, not borrowing. Plus, in another blow to the Chancellor, our sister channel Sky News reports this morning that the OBR has rejected the government's claim that its efforts to cut welfare spend will save £5 billion. The agency has downgraded the value of those cuts to £3.4 billion, potentially opening the door to further spending cuts from Reeves today. Yes, it's a pretty bad day at the office, isn't it? Anyway, it's not just the spring statement on the agenda for UK watchers. The country's Debt Management Office is set to announce its bond issuance plans shortly after Reeves' speech, with lenders expecting a new record outside of the COVID pandemic at £304 billion. This according to the latest polling from Reuters. Well, that's pretty gloomy, but let's see if John Cunliffe can make us feel more upbeat about things. He's head of JM Finn's investment office and former official at the Bank of England. John, I've outlined a few of the problems. I don't think I've gone into granular detail on the size of some of those problems today, but am I right? By all means, tell me if I'm not. Is this going to be just a horrendous day for Rachel Reeves?
It's going to be challenging. I mean, certainly if things were difficult last autumn against the backdrop of more moderate global growth and a slowdown in the UK economy that was already in place then, it's going to be even more challenging today. She's got a lot of things to deal with. She's got weaker growth, she's got weakness on the tax receipts side, she's got higher inflation and also higher bond yields. I mean, all of those coalesce to increase the borrowing. And of course, the budget deficit for this year is now going to be around 5%. OBR projections for growth for this year were around, I think, 1.7, 1.8. They're going to be down to about 0.8. I mean, what she really needs is for the OBR to say growth for next year is going to be the same as it was before. You can get back on track. But we've also got a much bigger existential problem, which is true of Europe more broadly, which is defence spending.
Yes.
Because a 3.5% spend on defence, which is an aspirational target but might turn out to be a real one, will cause an additional 35 billion shortfall in terms of the budget.
Yeah.
Plus you've got overseas aid as well. Put all that together, that could be as high as 48 billion over the next 5 years.
Take a step back, and a lot of people I've been speaking to were amazed, shocked, in horror at the NIC contribution increase for employers back in October as well. I've got a lot of time for listening to Rachel Reeves, and I think deep down her longer term plan on investment, stability and reform, it makes sense, and any chancellor would come up with those three as the pillars of the economy going forward. But in the short term, she says, oh, it's a problem in a changing world, it's Trump, it's the war. But actually, was this self-inflicted by the Chancellor?
I think it probably was. And I think, bearing in mind that the electorate were totally focused on public services, I think if they'd ran a campaign for the last election based around a 1% tax hike, for example, they probably could have got away with that. And I think people do view that national insurance hike as a stealth tax via the back door. And certainly it's landed badly with businesses and consumers. And we've not felt that yet. You know, we are going to feel it from next week. And certainly we've seen household confidence decline and we've seen business confidence decline alongside the narrative around trade, which is also having an effect in terms of global confidence.
And you mentioned that Europe has a common problem in defence. I think Europe has a common problem on productivity as well.
Yeah.
And I think this is where the really dangerous devil in the detail lies for Rachel Reeves today, because tiny changes to the level of British productivity, and I make no bones about it, it's something that everyone will look at as the headline, but if our productivity goes down by just decimals, that is even going to even more aggressively blow out her fiscal headroom over the next 3 or 4 years.
No, I mentioned that number to you, and I mean, again, the 3.5% defence spend is an aspirational number, but it might be a real one. You've got that foreign aid number that has to go back up again. Remember, we've cut that. But a small margin down in terms of productivity growth could certainly shave 20 billion as well off public finances. So that's a real challenge. And of course, whether you think public investment is as productive as private investment is absolutely key, because if you believe the public sector will crowd out the private sector, you've got a bigger problem.
Do you believe that? I have been brought up as a free trading, liberal, wheeling, capitalist, student, and I never have been told that the public sector is better at allocating capital than the private sector.
It's difficult. I mean, I certainly think in the years of austerity, and this is why we've got a reflationary budget, by the way, public sector investment was weak, and with that, public sector productivity was weak. So I think one of the major drivers of the budget we had last autumn, fair play to Reeves, was to try and enhance public sector productivity. The extent to which it will work is the extent to which we've got spare capacity in the economy. And if we've got spare capacity in the economy, fine, we can then grow and there won't be a crowding out effect. But it's not clear at this point which way the OBR will go. Certainly the OBR forecasts last year were for slightly weaker productivity.
Yes.
And of course
that's much lower than the OBR anyway.
And that's why growth was tailing off towards the end of the 5-year parliament.
John, I've got so many more questions for you, but you do run the investment office as well. What's the trade? What are your clients, your incredibly wealthy clients? What are they saying to you, or what are you saying to them that they should be doing?
Well, one of the things we're doing is we're building up reasonable positions in short and intermediate dated gilts, particularly the low coupon ones, because they're very tax efficient. Because we believe, and I believe, that the policy that we have in the UK in terms of the monetary policy side is too tight. You know, a neutral rate's 2 or 3 quarters, we're at 4.5. Admittedly, the growth inflation trade-off might be worse, but there's loads of scope, I think, for the Bank of England to cut rates, even if they don't want to do it now. So that's one thing we're doing. Second thing we're doing is making sure that we have a globally diversified portfolio, because we are seeing equity leadership broaden out by region and sector. So although we like the US, we like the mega cap, we are seeing earnings expectations sort of inflict positively, which is leading to better equity performance outside of the US. And those are the two main things. So a diversified portfolio, by region and sector, building up positions in short and intermediate dated gilts. And if those long dated forwards in the gilt market do rise further, I think the longer end of the gilt market, notwithstanding the public finances, could look very interesting as well.
We're not a wealth management, personal finance show, but is there anything tax planning wise that you would advise our viewers to do? Because again, they're a wealthy old bunch and they'd probably overlap with your clients on the Venn diagram quite nicely as well. There are real concerns about more tax hikes to come, and whether it be on inheritance, whether it be a wealth tax, whether it be on changes to what you can allocate or take out of your pension as well. Is there anything obvious that your clients and our viewers should just be being careful about?
Not at the moment, no. I wouldn't want to give any tax advice. It's probably outside my remit, but I would say low coupon gilts are very tax advantageous, and that's one of the key takeaways, I think.
In terms of those tax hikes, again, Rachel Reeves is going to say we're living in a changing world today, there are more challenges, almost beginning to tee us up for the spending review in June, which of course is more of a nod to her backbenchers who have got real problems with the spending review potential. If they're going to lose a lot of jobs to their constituents, perhaps I understand that. But also for the autumn statement as well, is this the start of a 6-month process where she's teeing us up for more tax hikes?
Quite possibly, yes. I do think that the appetite for austerity within the Labour Party is quite low.
But it's not austerity, is it? I'll just come back to that, because the Conservatives are saying it's austerity but in another name. She talked about spending 70 billion last time around. That's hardly austerity.
Well, it's a split between investment and day-to-day spending. I think that's the issue. But I do think that the appetite for meaningful austerity is going to be quite low. And I think the markets are going to be a bit sceptical as to whether she can kind of have some vague, unhypothecated spending reductions, in place for a 6-month period without saying what they are. Because I do think that we're now starting to see yields rise in Europe and the UK now based upon domestic fiscal reasons rather than the move of the US Treasury market. Because what's interesting is Treasury yields have fallen, bunch yields and gilt yields have risen. So suggesting there's something happening in terms of the domestic fiscal backdrop which is having an impact, and she can't allow that to drag on for 3, 6, 9 months because she could lose control of the bond market. I don't think she will, but she could do.
That was my next question. Nobody wants to see a Liz Truss quasi-Kwarteng type moment again. Even I think on the Conservative benches, it wouldn't really suit their purposes as well. How much are we meaningfully going to have to start looking at the competence of the Chancellor and the government economically? Because there is a lot of polls doing the rounds at the moment where competence and economic management scores are incredibly low.
I think it's the data that will actually determine it. And I think one thing that probably is going to help the government is that the ONS, who have had various issues around statistics, not just the labour force survey, but also the seasonal adjustments, could easily report better first half growth. If you look at the last few years, what's happened is first half economic growth in the UK has been stronger, second half has been inexplicably weaker. So she may have a get out of jail card simply because the seasonal adjustments actually cosmetically push up first half growth, and that gives her a little bit more wiggle room. But no, there is an issue. I don't think it's an existential issue, but I do think that what could be a perfect storm for her, and I'm not expecting it, but could be, is that if the long end of the US market, Treasury market, begins to sell off.
Which is what I said to Andrew Bailey, and he's like, no, we're okay.
Well, no, because we had a 40 or 50 basis point decline in Treasury yields. We've had a 40 basis point increase in bunch yields. We've had a 30 basis point increase in gilt yields. Now, that's unheard of. You never get those moves, and that tells you about the changing world order. But the shoe to drop, or the penny to drop, could be the long end of the US curve, which, if Trump gets his spending plans through in terms of tax cuts, for example, as the extension of the Tax Cuts and Jobs Act and then further tax cuts down the line, that could easily see a long-term Congressional Budget Office forecast of around 140% debt to GDP.
Yeah, just a 9% deficit or something like that.
Which makes the 85% number we've got over here look quite modest. So there is an issue out there where fiscal dominance in the US could take over and become a problem for us. And that's the thing I'd worry more about as a UK bond investor rather than domestic fiscal policy.
Got to leave it there. We had a good go at it. John, nice to see you. Thank you very much indeed for joining us at our Westminster Bureau. John Cunliffe, head of JM Finn's investment office and former official at the Bank of England. We've got a blockbuster day here in the United Kingdom, including the final look under the hood at the UK economy before Reeves' statement at 7 a.m. GMT. We've got UK CPI data. It's going to be slightly better than last time, we think, but it's not going to be perfect, that's for sure. Way above target is the point. And you can catch the spring statement in full on CNBC International's live YouTube page. That'll come from 12:30 London time. And now over to Juliana. Juliana, lovely to see you. You should come on Squawk Box more often.
Oh, Steve, well, thank you for having me. It's a pleasure. Maybe I will stick around. It's also great to see you in the Westminster studio this morning. We are going to take a quick break, but plenty more coming up on Squawk Box. U.S. President Donald Trump continues to tease the market on tariffs after the EU's trade commissioner meets in Washington for talks. We'll bring you the latest after the break. Plus, Apple faces headwinds in China as sales slow. We'll discuss Tim Cook's visit to the country later this hour, and we'll be joined by Vince Cable, former UK Minister for Business, as Rachel Reeves prepares to deliver her first spring statement. Stay tuned for that interview coming up at 8:30 GMT. Welcome back to the program. Let's get you a check on markets. Of course, all eyes are on that spring statement here in the UK, but stateside, the volatility continues as investors try to grapple with the uncertainty on the tariff front. Yesterday, though, we did see all three of the majors eke out some marginal gains. You can see the Dow Jones added about 0.01%, so essentially flat on the day. The tech-heavy NASDAQ led the gains about 0.5% higher overall. In terms of treasury markets, here's where we sit. You are looking at, we can get you the yield curve there. You got the 2-year trading at just over 4%, the 10-year trading around 4.34%. The dollar yesterday retreated marginally, breaking a 4-day win streak. Right now, euro is trading slightly weaker versus the greenback, down about 7 basis points. Sterling also on the back foot versus the dollar, trading around 129.29. So it has been hovering around that 129 mark for some time now. In terms of commodity markets, here's where WTI and Brent are trading this morning higher. We've got to both about 1/3% higher. Gold also getting a bit of a bid this morning, up about 12 basis points. Overnight trade. In the previous session, we saw a sell-off in the Hong Kong market, about 2.3% lower in yesterday's session. A little bit of a bounce back now this morning. The Hang Seng up about 0.4%. The Kospi over in Korea about 1% higher, and a bit of green for the Nikkei 225 in Japan, as well as the Shanghai Composite in mainland China. As for Europe, yesterday the Stoxx 600 posted its first gain in 4 sessions. It ended the day about 0.7% higher over some optimism from investors on the tariff front. Now, this morning, we are looking at a little bit of green on the board, but essentially a flat start as investors await that spring statement here in the UK.
It still looks cautious out there, doesn't it? Some of those FANG stocks on the move yesterday, but that was pretty much about it. And let's come back to the big trade news as the EU's Trade Commissioner Maros Sefcovic says he has held, quote, substantive talks with US Commerce Secretary Howard Lutnick and Trade Representative Jameson Greer in Washington on Tuesday. This is the bloc looks to fend off the harshest of President Trump's reciprocal tariffs. However, the result of the meeting remains unclear. President Trump continues to tease the market on tariffs, saying he does not want to offer too many exceptions. Talking to Newsmax, Trump hinted he could still be more lenient, even as he once again attacked America's trading partners.
Not too many. Not too many exceptions. No, I don't want to have too many exceptions. Yeah. Look, we've been ripped off for 45 years by other countries, 50 years more. We always were soft and weak. It's almost like we had people that didn't know what they were doing. And all we're going to do, it's reciprocal. We're just going to be reciprocal. In fact, I'll probably be more lenient than reciprocal, because if I was reciprocal, that would be very tough for people. But we've been ripped off as a country like no country has ever been ripped off before.
The prospect of a recession looms large over the US economy, with 60% of corporate CFOs saying they expect a downturn by the second half of the year, with most blaming the White House's trade and tariff policies. That's according to CNBC's quarterly CFO Council survey. Frank Holland has the findings.
When we asked CFOs in our exclusive Q1 survey about the biggest risk to their business, the top answer, U.S. trade policy. The next two answers related, at least to some extent. The number 2 answer, that was inflation. Consumer demand was the number 3 answer with 20% of responses. A key part of U.S. trade policy, obviously, that's tariffs. We asked CFOs about the impact of tariffs. We really got a wide range of responses. Let's start with the strongest of opinions. 55% said they just don't know the impact of tariffs because they're not sure which ones will stick. 25% said tariffs would not help the U.S. economy. Then we have the, kind of not so sure answers. 20% said they agree somewhat that tariffs will help the U.S. economy. No CFOs answered that they strongly agree that tariffs will help the U.S. economy. 60% said they agree somewhat that tariffs will lead to a reacceleration of inflation. Speaking of inflation, the Fed getting high marks on how it's handled rising prices. 15% of CFOs say the Fed is doing an excellent job, but only 5% are critical. But they're still skeptical about the Fed's 2% target when it comes to inflation. About 2/3 see the Fed reaching that goal in 2027 or later. A quarter say they're just unsure when the Fed will reach that 2% inflation target. Back over to you.
U.S. consumer confidence takes another hit with the Conference Board's monthly index for March falling to a 4-year low. Worse still, the gauge for future expectations hit a 12-year low, coming in well below the level seen as a signal for a recession ahead. Well, Karen, I think this confidence data is being more closely watched than usual these days because the soft data has been really concerning, but the hard data so far has been holding up. But clearly there is a link, and the concern is that this weakness that we're seeing in confidence is going to translate to lower spending from both consumers and businesses and could eventually lead to an economic downturn in the U.S.
There's a lag effect, isn't there? The data that we're getting now, the hard data, so to speak, is everything that has transpired so far. But the survey data that the market is now carefully picking through suggests, is confidence plummeting from here, and what does that do to intentions on spending, investment? Will that set the US on course for some sort of a setback economically as a result? Looking at the commentary, I thought it was fascinating, at least when it comes to Europe. A very bland statement from Sefcovic on Twitter, on X, so really not getting into the weeds very much on negotiations, and nothing from the US Treasury. Is that a positive? Because often when you step away from the megaphone, then that's when progress is made, so fingers crossed on that prospect. Of course, Trump is still talking about Liberation Day, but let's just hope that some of the allies are not sacrificed on Liberation Day. The other point I'd make is that he also threw currency into the conversation as well, in terms of not just some of the tariffs that they're facing, but there are other things that he's taken issues with, taxes, fines, but he's also mentioned currency. Where does that leave the US? And that really captured my attention because over the years, we've seen, even under the previous administration, these subtle lines about labeling certain countries manipulators, but very little follow through. So does that mean that if we do see large fluctuations or devaluations in currencies from here, that Trump will be very active? And is that something to watch on the horizon?
Well, certainly, I think when it comes to China, that's always seen as a possibility that they look to, use their currency as a way to fight back against tariffs if we do see an escalation in U.S.-China tensions from here. Coming back to the survey data yesterday, I think what's important here is, like you said, so far the hard data does not suggest that these concerns are hitting the consumer yet, and that came through in the survey from the Conference Board yesterday. Right now, the consumer is fine. It's all about the future. They're concerned about interest rates. They're concerned about tariffs. They're concerned about inflation. And I was listening to the Conference Board yesterday speaking after the data came out, and they said the consumer is maxed out on debt in the U.S. America is living paycheck to paycheck for the most part. So sensitivity to inflation, if we do see it pick up on the back of these tariffs, if, to your point, we do see an escalation in trade tensions between Europe and the U.S., surely this is going to have a major impact, and that's why we're seeing all the concern out there.
It depends on how it plays out, and there is a view on some of the big international institutions that the country that is getting fierce with tariffs is the country that wears the impact of those higher costs, i.e. the US put some tariffs up at its border, it's US consumers that pay the price. Is that going to be the case? I know India already was looking at negotiating down some of its tariffs. Would there be some positive impacts on the back if any negotiation was positive? Clearly reciprocal tariffs go in the direction that is negative for everyone, but if there is some response, is it positive? And even when it comes to Europe, I was looking at some of the tariffs, the 10% tariff that exists at the border, if that is removed, would we see a flood of US cars coming into Europe? Possibly not. There's the logistics, right? So why not sacrifice something like that that is not useful overall? Is everybody going to start buying some massive American car?
We're going to start seeing F-150s around here.
And then they have to fill it up. Exactly. It's probably not going to fit on the road. So why not give some of that away? Why keep some of those border protections when they may not even be necessary?
I think your point about who's going to ultimately bear the cost of these tariffs is an important one. And a few weeks ago, there was a story that Walmart, this massive buyer, they've got so much leverage when it comes to their vendors. They were allegedly going to their Chinese suppliers saying, you eat the costs of these extra tariffs. The Chinese government didn't like that and pushed back against Walmart. But clearly, you're going to see some of these big corporates try to pass these costs to, I think, initially their suppliers if they can, and they'll try not to pass it on to consumers, but ultimately someone's going to have to pay.
Final word, the Canadians not rushing to negotiate. We've seen that from Trump and Carney, the stoush that's been happening with the Canadians. Carney is certainly not speeding towards the White House to have those conversations. So it'll be interesting to see how the different leadership tactics play out in this window. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.